P/E ratio, P/B ratio, and EBITDA are financial metrics used by investors and analysts to evaluate the performance and valuation of a company. P/E ratio. Price-to-earnings ratio, P/E ratio is the ratio of a company's share price to its earnings per share, EPS. It is a valuation metric that indicates how much investors are willing to pay for each rupee of earnings generated by the company. A high P/E ratio indicates that investors are willing to pay a premium for the company's earnings potential, while a low P/E ratio may indicate that the company is undervalued. P/B ratio. Price-to-book ratio, P/B ratio is the ratio of a company's share price to its book value per share, BVPS. BVPS is the total assets minus intangible assets and liabilities divided by the number of outstanding shares. P/B ratio is a valuation metric that indicates how much investors are willing to pay for each rupee of the company's book value. A high P/B ratio may indicate that investors are willing to pay a premium for the company's assets, while a low P/B ratio may indicate that the company is undervalued. EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA is a financial metric that measures a company's operating profitability before deducting interest, taxes, depreciation, and amortization expenses. It is used to evaluate a company's operational efficiency and cash flow. EBITDA is often used by investors and analysts to compare the profitability of companies in the same industry, as it eliminates the effects of non-operating factors such as interest, taxes, and depreciation. In summary, P/E ratio and P/B ratio are valuation metrics that indicate how much investors are willing to pay for a company's earnings potential and book value, respectively. EBITDA is a profitability metric that measures a company's operating profitability before accounting for interest, taxes, depreciation, and amortization expenses.